Hey, all right, it's Scotty from Zenium Live, and we made it eventually. We had some technical issues coming out of our Sydney studio, which is down there today. We're joined by PJ Patterson. G'day, PJ. How you going?
I'm good, Scotty. How you doing? Yeah,
I'm
technical
good.
difficulties for sure.
Yeah. All right. So look, PJ, I decided to really want him on today because of everything going on in the markets and in the world and in probably your life. So I'll just give you a bit of background of PJ here. So he's the founder of Keystone Financial Services, a financial planning and wealth management firm in Sydney. He's an award-winning financial planner and finance broker. Did you write this? Did you, mate?
Yeah, just keep reading, mate. You're doing a great job.
Yeah, okay, all right, okay, just checking. Winner of Best Community Engagement Award from New South Wales, MFAA 2019. Best Diversified Business Award 2019. He's been featured in Australian Broker Magazine, Elite Broker Podcast, Business for Good Podcast, and he's host of Money Matters Podcast. And today he's the guest on the Zenium Live show, which is also our Real Property, Real Wealth podcast. So welcome, mate.
Thank you. Thank you very much. It is great to be with you. And I don't think I could have read that better myself, even though I wrote it. So well
Yeah.
done, sir.
That's right. I do what I can. Well, look, as I alluded to at the top of the show, I really wanted you on because, well, I mean, we are a property show, but there's a whole
Hmm.
bunch of other assets. I mean, essentially, everyone has superannuation in Australia. And that
They do.
superannuation, unless you have a self-managed super fund and it's solely in property, there's a
Hmm.
fairly good percentage chance that you have some sort of interest, or financial interest that is, in the stocks and shares market. And so that's the reason I wanted you on today. So, mate, I know that you were fairly prepping your clients coming into, mid 2019, 2020. You're telling me just off air. And I guess I want to touch on why is that? What led you to do that? What have you done for your clients? And how are they sort of going through this time? And then lastly, we'll get into what you think is going to happen moving forward. So, mate, how did you see this coming?
Wow. Well, that's a mouthful and a half. There's a number of issues and things to cover in that. So we'll definitely hit all of those. Before I before I address any of that, though, what I do want to say, and this is the standard disclaimer that all financial planners probably need to give out, is that a lot of what I may say today or discuss is going to be general advice. So if you have an advisor that you work with, or if you're thinking about, as a result of this, going and getting some advice, I would encourage you to do that. So please just kind of take this as general advice, because I don't know your personal circumstances, and that could be, a danger to you if I say, go and sell everything, which I might actually say that. You never know. I wouldn't want you to rush out tomorrow and do that. So make sure that you speak to somebody before you make any decisions. That being said, towards the middle of last year, it was quite obvious that the world economy was slowing. Now, you wouldn't have guessed that from the mainstream media and the way a lot of things were being portrayed. So everybody's like, oh, everything's great. Consumers in good shape. Debt levels are okay. Economies are growing, all this sort of thing. But under the surface, there were a number of metrics that weren't looking too good. And one of those metrics were corporate earnings. Now, I'm kind of speaking specifically about the US here when I'm talking about corporate earnings, because a lot of the data that I track, the US is a rich place to get data. There's a lot of information that's generated by the government, by investment houses, and non-government organizations. So there's a lot of data. And the data was suggesting that we were actually slowing. So as a result, I began to position my clients for a slowdown, which really was going to look like what has sort of occurred up until COVID-19. So I'll cover that in one second. But
Yeah.
we were coming into a slowdown. It was going to be a cyclical slowdown. So the business cycle was beginning to slow. We were sort of full. It was a full cycle. We had full employment. Wages were starting to rise. Earnings were starting to compress. All this sort of thing. So that's typically what you see in a very late cycle in the stock market. And so it's pretty obvious that we were going to have a slowdown. Now, typically when that happens, what you want to do is pivot out of stocks. So all the big stuff like your secular growers, like the Facebooks and the Googles, and all the really sexy stuff like Amazon and all of that, the big tech companies, they were going to start slowing. So we just took money off the table, got out of stocks, positioned ourselves in things that would do well in an environment where interest rates were going to start to fall. And that was the other thing, is we started to see the Reserve Bank and some of the other central banks start making noise about cutting interest rates, and the bond markets started to price in interest rate cuts.
Yeah.
And that's what started to happen. So anyway, we sort of pivoted from stocks over to fixed income and treasuries and things that do well in a lower interest rate environment. So that's what we saw coming into sort of the latter half of last year. And then at the beginning of this year, what comes along? Coronavirus, right? COVID-19, boom. Now, I would describe that as a black swan. There is no way that really anyone would have seen this type of event coming. It was something that, would have been like the GFC, where all of a sudden, bang, you just get this event that really has handicapped badly the global economy, and it's probably going to be getting a little bit worse. So there's still a playbook that you can have on with a situation like this. And really, I mean, at this point, it's to stay in cash more than anything. And that's the way I pivoted clients, even in the last couple of months, is to go, oh my God, like this is a really bad situation. And I'm happy to elaborate more on that, but it's a really bad situation. And until we start to really understand what this means longer term, you kind of have to just stay safe and probably not be an investor in this environment.
So that's your analysis of what you did and what you saw last year. So you saw some things coming. You started, pivoting your clients to out of more riskier products to sort of fixed income style products, etc. And so most or all of your clients were in that situation when we come into the start of this year and COVID happened, right? That's what I'm hearing?
Correct, 100% correct. So because we were already positioned out of growth stocks and big exposure to stocks, so I still had a few small positions on. So one of the models that I use is called a quadrant model. It's a full cycle investing model. I'm happy to elaborate on that a bit later if you like, but the bad quads are quads 3 and 4. Those are sort of the quads where you see a recession, where interest rates are falling, GDP is falling, and of course growth is declining, and inflation is declining as well. And so we knew we were going to be in that quad 4. So there's a playbook that you have on for quad 4, which is to own things like treasuries, real estate investment trusts, utilities, consumer staples companies, things of that nature. The US dollar is actually quite strong in that environment, as is gold. So all of those things we owned. And then COVID came along, and the volatility in the market went through the roof. And if there's anyone who trades stocks or sort of is, into that sort of stuff, you would probably be familiar with one of the main volatility indexes called the VIX. And for anyone interested, that ticker symbol is VIX. There's a volatility index for Australia as well. I believe the ticker symbol is XVI. And volatility spiked up into a regime that is not investable. Mm-hmm. So when volatility goes through the roof in a stock market index, or there's volatility, you can measure volatility on anything, but particularly on a big index like that, like the S&P 500, when volatility spikes above 31, which was the level above which you kind of have to not be invested, which it did. It went up to. Are you sitting down, Scotty? Yes, you are sitting down. It went up to around 75, and intraday one day it hit 83. So it was a complete. I don't know if this is a family show, but mate, it was a shit show, and it was.
So hang on. So just because obviously we're talking to a bunch of property people, and look, I'm not saying that our guys don't know this, but I mean for my benefit. So the volatility, is this out of 100 or is this an infinite number? This index?
It could be an infinite number. It could be an infinite number because volatility. I'll give you an example.
Yep.
Yeah, I'll just give you a quick example. So oil has been exceptionally volatile. Now the oil volatility index is currently at about 170.
Right.
Okay. So yes, it's not on a scale of 0 to 100. It's on an infinite scale.
Okay, but general market stability and happiness is below that 31 point. Is that what I'm hearing you say?
That's for the S&P 500. Again, each sort of item like Currencies have a much lower volatility than the stock market. Gold has a lower volatility metric than the stock market. Treasuries have a different volatility measure. So everything has its own volatility, and there are certain levels at which you would get into or out of all of those as well. But just to be simple, and because it's easy to look up, the VIX is one of those key metrics and measures that stock market people look at. And when, as I said, when volatility goes above 31, that's the level at which on the VIX, on the S&P 500, you go, oh, time out, I'm out. And commensurately, when it's between say, 9 to 15, that's happy days. And we were there like 3 months ago. If you go back and look at a chart of the VIX, 3 months ago even, the VIX was like 14 and a half. Right. And today I don't know, I haven't checked it today, but it's around 45. It's come down a little bit, but it's still in that regime of volatility that you cannot invest.
Yeah. Okay. And we've got some comments here as we go. Cheryl's saying hi. So hi, Cheryl.
Oh, hey, Cheryl. Great to have you with us.
Yeah.
She's a baseball mate.
Oh, but yes, well, we didn't get into the fact that you're an award-winning baseball player as well. But
I don't know about award-winning.
We've got our serial commenter Steve Skeen is on. G'day, Steve. Are you advising on direct shares or managed funds or both? In terms, I think he must be talking about for your clients.
So I typically that's a fantastic question, Steve. Thanks for that. I typically use ETFs. Which is basically a share. It trades like a share, but it has a managed fund element to it. So managed funds, as you probably know, are priced one time a day, and that's usually at the close. That's the net asset value that you see often in the print on Yahoo or wherever. Whereas an ETF is built like a managed fund, where it has maybe 30, 40, 50 stocks in it if it was a stock ETF. But it trades throughout the day, just like a share. So as the underlying shares in an ETF fluctuate in value, the value of the ETF also fluctuates in value. So I advise, but to tell you, I guess broadly, I advise on everything. So I am a global asset manager. I'm a global macro guy. And that's the way I view the world. So I'm kind of asset class agnostic, which might be why, Scott wanted to have me on, because I like property. At certain times, I think property is a fantastic investment, but there's also other strings that you need to have to your bow, and shares and ETFs are certainly one of those.
Yeah, no, that's good. Okay, so you saw the volatility index, I guess, climbing, and we've obviously peaked when COVID come on. Your clients are in a defensive position. I don't know how you describe what you've got your clients in a position.
Great way to describe it.
Yep. Defensive. Okay.
Yeah. It definitely. I mean, I was going to be cheeky and say it's the zombie apocalypse position, but not quite. We're not there yet. But but it's definitely a very defensive posture, and that's, one of my mantras in my business is don't lose money. You must protect capital. And that's so important in investing, whether it be in property or shares or treasuries or, fine wine or art or anything like that. You want to and need to protect your capital, because those are your little soldiers, right? That's your ammunition for being able to do stuff. And so it's super important to try to not, lose money. And if you do have to take a loss, you'd much rather take a small one than a big one. So
sure. Yeah. No, that's a good point. Okay, so your clients are in a defensive position already, and then COVID comes along. Now, do you remember what your plan was? Like, how were you going to watch the market this year? I mean, you didn't know COVID was going to happen, but you'd got your clients into a defensive position. What indicator do you watch? That VIX indicator style thing again to see when volatility changes? Like, when would you have changed their position if COVID hadn't happened?
So if COVID had not come along and volatility had spiked to the level that it had, we would have been owning things like, to be fair, we still have some treasury positions on. So I still own the short end of the curve. For any of you that understand interest rates, I own the short end of the curve in treasuries. So we still have a little bit of that on, and I'm exposed to the US dollar. So I've sold Aussie and I've bought US dollar. So we have a currency position on as well. But they would have been positioned in things that do well in an environment where recession is likely, interest rates continue to decline, which would have happened anyway. That we were already doing that prior to COVID, but they came out and took the absolute hatchet to interest rates after COVID. So we were already in the declining inflation, declining interest rates, and declining GDP situation, and that means a playbook of things that are interest rate sensitive. So knowing that interest rates would be cut to stimulate the economy, you want to own things that do really well in an interest rate environment. And guess what? One of those things is property.
So, okay.
Do you like how I circled that back around?
Yes, that was wonderful. Thank you. So
My pleasure.
So you're looking at a low interest rate environment, so therefore property was more appealing. Is that, I'm just trying to put it into Scotty terms.
Yeah. Okay. So one allocation, or one part of the portfolio that you would have an allocation to would have been a property ETF. So
Gotcha.
real estate investment trust, basically. Yeah.
Yep. Okay. So all right. So that's fine. So you're watching that, but then COVID did happen. Okay.
Yes.
So you were already in the defensive, ready to keep an eye out. So your eyes are being kept out, and you're probably being kept awake at night. Who knows? But what if anything has changed, or does that just delay now? You just don't do anything for a bit longer. Like, what's your plans for your clients right now?
Excellent question. Right now, it is definitely wait and watch and see what happens. So a couple of things that I'm watching right now to see, first of all, if volatility comes down in them. One of those is gold. So, and I'm not talking about physical gold. I'm talking about an ETF that holds gold, because you want to be able to trade in and out of these things, not necessarily own them long term. Mind you, I think everyone should have maybe a little physical gold in their possession. It's just a smart thing to have, and it's a great store of value long term. So you could put 2 to 5% of your net wealth in that. But for more of a trading position and something you would rotate out of as the economic and stock market conditions dictate, would be gold. So I'm actually waiting to see if gold's volatility comes back down, because I will allocate some capital to that. Mm-hmm. I'm also waiting to see what happens with interest rates. So at the moment, we've seen interest rates sort of ratcheting down and then back up in sort of a trading range. And so I'm waiting to see if we get Treasury rates, this is in the U.S., up to a certain level, then I might buy some Treasuries. But honestly, at the moment, it's U.S. dollars, Treasuries, a little bit of Treasuries, and then sniffing at maybe some gold. So cash, predominantly cash, probably an easy 90% cash.
Okay. All right. So that's the snapshot of where you got to with your clients. Now, there's a whole bunch of people, and I'd say the very majority of who watches this show who aren't your client. So what can they do right now? Obviously, practical stuff. We're not saying, you need to develop a financial plan. Like we know that, and that's probably should go without saying, but it should be said. But the simple fact is, I'm not trying to get you to stand on anyone's toes. I'm just saying, from a practical perspective, what can they do to safeguard their wealth right now?
Okay, so the first thing I would certainly do is put any big purchase on hold. If you're going to buy a car, if you were thinking about buying another property or something like that, I would probably just hold that thought for the moment. There's a couple of reasons for that, but that would be number one. I would delay any major purchases, only because there's a lot of uncertainty out there. The second thing I would do is, because most working Australians have superannuation, they would need to dig out their super statement. So unfortunately, industry funds and a lot of the platforms and stuff only send statements twice a year. And so I would dig that out, and I would get online or call them and get some information on your current account balance, because I dare say right now we're having a bear market bounce. So the markets have been pretty good this week, but it is a bear market bounce. And I'll elaborate on that in a second. But this would be a good time to go to cash or sell if you were worried about further decline. And I actually think there is a serious risk and a reasonably high probability that we will see further downside in this market. And the reason I say that is because we have not seen fully the effect in GDP of the G20 of COVID.
Yeah. So you touched on industry funds. Now, I heard a whisper this week. I can't remember where it came from, but they were talking about, it reminded me of the old GFC days, and some industry funds were talking about capping, limiting, or not allowing withdrawals or something like that. I just heard it in a conversation I was on online, but what do you have any news on that?
Well, there was an article yesterday about the industry super funds, and I believe it was, I probably shouldn't say their name, because of the thousands of listeners you have in the
Yeah,
syndication and
we're
everything.
global. We're global.
But I think it was Hesta that came out supposedly and made some commentary about the fact that they had amended their PDS, their product disclosure statement, which would allow them to put on hold any redemptions. Now, today there was an article, a response from sort of the industry fund body that said, well, we kind of already had that capability anyway, so I don't think it was anything new. And they reiterated that they should have the liquidity and be able to provide the liquidity should people need to, as an example, avail themselves of the government's $10,000 this year and $10,000 next year super withdrawal if you are in financial hardship. So I think it was interesting that there was that accusation and then a very quick response. For me, I believe that people should have control of their money. You do have control of it in an industry fund, but your options are exceptionally limited. Mm-hmm. And I know they make a big deal out of, compare the pair and all this nonsense. But the reality is that I think if you looked at their balance sheets and the way they are invested, they do generate a little extra alpha or return by investing in slightly more liquid projects, infrastructure projects, and things like that. So I don't know. I mean, it's anybody's guess. If there was a run on the super funds and you had 300,000 or 400,000 people all of a sudden putting in these $10,000 this year and $10,000 next year, claims, it's a lot of coin. So I don't know. It's I'd say wait and see. But back to the point about all that, if you do have an industry fund, you really ought to know what's going on inside of it.
And I mean, how easy is that to find out? I mean, it's not my area; that's your area, right?
It's pretty simple. I mean, as I say, everyone would get, as long as you haven't moved around a lot and you've been good about updating your address with your providers. Usually in January and sometime in July, you receive a statement from your super fund, and it will tell you what your balance is, what the performance has been. It'll have a schedule of the transactions and the fees and things that have come out for that half year, and it'll obviously have your account details and everything else. So as long as you keep those things or scan them and file them, you'll be able to get at the very least, where are we, March, you would at the very least have the 2 December numbers hopefully available to you. Okay.
Now I want to touch on a couple more things. One is, I understand that your view of volatility is quite high at the moment, and the index is proving that's to be the case. Are you on the lookout is there such a thing as looking out for a good deal in this time in the stocks and shares space, or and if so, what should people be looking for?
That is a great question, and it's one that I'm getting as well from my clients. When do we start to bargain hunt? Now, the problem is
because that's what I do, right? I love bargain hunting. Is what we do.
So, I know you do. Yeah. You do, absolutely. You're always looking for the bargain. So here's what I would say about where we are right now in the stock market. So first of all, everyone is in a super big hurry to have this correction be over. But because in the past, whenever there's been a hiccup in the markets, even just a 10% decline or something along those lines, the Fed has rushed in and the central banks have flooded the market with money, and everybody has gone, oh, hooray, again. This is the central bankers I'm talking about. But this time is different. We have, an external event, this COVID-19 situation, which has affected global. I mean, it's a global thing. Like, we are literally shut down globally for all intents and purposes. So my advice to people is, look, we have got to wait and see what the data looks like for the first and even probably the second quarter GDP numbers out of the US and Europe and all the countries in Europe and the UK and Australia, to see what the damage economically is. Because the problem with valuation is you could look, for example, here's a great example, right? You could look at the bank stocks a week ago, because everybody loves the bank stocks because they pay dividends, right? You could look at them a week ago and said, hey, most of them are down 40% this year. And they are. They're down 40 to 45%. And you could have said, wow, look at that juicy dividend. Like, that's, I want to get me some of that 9% dividend at NAB or wherever. But guess what just happened yesterday? APRA came out and said to the banks, well, guys, you might want to consider cutting your dividend because we want to make sure you guys have enough cash flow through all this to stay solvent. So all of a sudden, you then go, well, holy geez, right? My dividend at 9% might be halved to 4% because they cut the dividend. And this is exactly what happened during the GFC, by the way. Many companies, including the banks, stopped paying dividends. So the point I'm trying to make is for that sort of buy-side analyst who goes, oh, look at the valuation, this is so good. The problem with valuation, one of the inputs is earnings, right? Which flows down into obviously your cost structure and then what's going to be left over to pay shareholders a dividend. If you don't know what the earnings are going to be because you just don't know how the economy is going to behave, then you cannot realistically value a company. And that's what I'm saying, I think, is where we are right now with obviously not all industries, but with many, many industries. We just don't know how they're going to be affected. And there's so many connected things now with this COVID thing, with small businesses being shut down for all intents and purposes. The consumer has been sequestered, right? So retail's a mess, malls are vacant, all of this stuff. We just don't know. So until we get some more clarity on that, I'm just saying to people, look, you may think something's cheap, but I'm telling you now, it can get cheaper.
Yep, sure. Okay, that's a good point. So we've got a semi-regular watcher here, Lachlan, saying I have to check this on replay. Well, mate, if you're on here now, you should be watching it live and check it on replay. That's what I'm going to say to that, Lachlan. And we've got Stevie's back. ASX is up 180 points today, which is exactly what's been happening, right? Up, down, all over the shop. I mean, this is
Sure.
exactly what you're talking about, the volatility side of things.
Indeed. And, the ASX, I didn't do the calcs I meant to, but due to those technical difficulties, I didn't get a chance to do it. But the ASX this year is down about 20, probably still about 25%. So, hey, it feels great when the ASX bounces like that and is up a big amount. I'd be curious to see what the mainstream media narrative is on that. But you know what, Steve, it could easily be down. We got a long weekend coming up. We got all this nonsense going on with OPEC and stuff. We could easily see it down, 200-300 points next week. I'm not saying that's definitely going to happen, but this is, again, I'll go back to what I said earlier. This is absolutely a bear market rally. And just on bear markets, bear markets don't conclude in like 1 or 2 months. Like first of all, we're going to have a recession in Australia if we're not already in one. I know we don't like to talk about that. And I've lived in this country 22 years, right? All recession free. I've loved it. But we're going to have one, guys. I mean, we're on the cusp if we're not in one already. And so when we're in those sorts of environments, these things happen. You get stock market rallies, and then I think it's just the calm, it's a consolidation before we fall off a cliff again. At least that's how I'm positioned right now.
Yeah. Well, you're in the defensive mode, ready to just stay and defend. So so going back to the practical stuff for people moving forward, I mean, we talked about the super, checking where that's at. As I said, it goes without saying we need a financial plan. I mean, budgets. The people have got plenty of time, right? They should be looking at their budget.
Absolutely. Well, I'll tell you what, we got a 4-day weekend coming up, and we're spending a lot of time at home. And for those of you who have kids still in school, obviously you've been probably tearing your hair out, which explains a few things, Scotty, tearing your hair out, having the kids at home. But, look, my wife's a high school math teacher, and the number of emails she's getting from, parents going, oh, my God, like, so sorry, my kid's such a pain in the butt because I can't control him at home. So I can only imagine what you have to do with the school. But there's a lot of opportunity right now to do personal development. YouTube University is one of the best places I found to do that. One other thing I've loved, I signed up for that masterclass website a few months ago before all this, that, they run the masterclass from all these brilliant people like the screenwriters.
Yeah, I was asked to go on there, but I was too busy, mate.
Yeah, I'm sure. Yeah, maybe that's next year. That's your next year project. But there's so many things you can do right now. Even just read. Even just find those books that you bought, over the years. You say, I'll read that one day. Just get stuck into that. But I think now's a great time just to focus on inward learning. Focusing inward learning, improving yourself for sure.
All right, so one question I always get asked, which relates in the property space, and I'm going to get your take on it on the record, is that interest rates, well, the RBA is sitting at 0.25%? I think that's
Quarter
what it's at
percent.
the moment.
Yeah.
Yep.
Yep.
This is going to sound like a silly question, if you asked this 3 years ago, but how low can they go? Can we go below O?
Of course we can. Will they is probably the more interesting question. I think the Reserve Bank in Australia has been fairly clear on this, that they will not be cutting rates any further. I mean, another 25 basis point cut is, who cares? Like, there's just nothing left in it. No, seriously. I mean, there's nothing left, right? Like, it is there. It is there for all intents and purposes. So another 25 basis point cut is just, they won't bother. But here's the thing about interest rates. They're not set by the RBA, really. The rates that you and I pay for lending, for our credit card, for day-to-day stuff, actually are not set by the central bank. Yes, they have a rate that other banks price some things off of, but the reality is that the multi-trillion-dollar global bond market is what prices debt. So if you're seeing the bond markets trade higher, so bond prices continue to rise, then interest rates are coming down, and that's the market that's pricing bonds. So if you see bonds go to a price that makes the yield on that bond negative, then we're in a negative interest rate environment. That's kind of how that mechanism works. Could we see Australian debt go to that level? I doubt it, probably because we just had a downgrade, I think yesterday, by either Moody's or S&P of our banks, and so they downgraded their credit. So they put them on, I don't know what the rating is now, but that'll be now harder for our banks to raise capital overseas, which means that we could see higher interest rates for property loans and the such like.
Well, they have to make their money, right? Somehow. That's how they do it. It's on the spread, right?
It is on the spread. And frankly, we actually, to have a healthy banking system, you need to have the banks making money. I mean, as much as we all sort of have this love-hate relationship with banks, you definitely need banks to be profitable, because they perform a very important function in our society, and that's to keep credit flowing and trade flowing and everything else. I mean, we don't want them to make too much money, of course, but yeah, they need to have interest margin in order to make money. Yeah, for sure.
Yeah. All right. No, that's good. So we've covered, what you saw going in, what you're doing now, what you're seeing moving forward. With bargain hunting, negative interest rates. Mate, is there anything else that you want to cover before we sign out? Because I think we've covered a lot of ground there.
Yeah. Well, I think Australia, and I do actually, I think Australia has been really hit hard with all of this stuff. And it goes back to the bushfire season, right? We had horrendous bushfires. We then had some floods, right? Because then rained, absolutely pissed down with rain. And now we've had COVID-19 really disrupt our economy. So if I could say anything to people listening and anyone that might listen to this, if you're in Australia, it is, when all this fog of whatever lifts, spend money in Australia. Go on a holiday somewhere nearby. Go on a holiday in your state or in a local community. Support small business people as well. Like, if you can go out and do your shopping. I mean, I know the majors, obviously Woolies and Coles, they're going to provide a pretty big service to us during this time. But try to support your local businesses as well, because 90% of our economy is actually driven by small business. So that's what I would ask anyone watching this to do, is when we're actually free to get out and not be fined, $1 gazillion for walking down the street, it's to go into the local shops, buy the things, because there's going to be people are going to have a big blow off. They're going to want to go out and spend, right? Like, keeping them at home sequestered and the malls closed and everything is going to have a lot of pent up demand. So go and spend money locally if you can, and let's try to refire this economy. Because on the back end of this, we're probably going to enter an epic boom, another epic boom. I don't know what it's going to look like, but out of all of this economic destruction, you always get the phoenix rising. because it's a cycle, right? So let's help it kick it off.
Yeah, look, I agree. I think that in these downward times, I was on a training call earlier today that I was actually presenting, and I know it's hard to believe. I sometimes have a clue about something, and I did say that. It's kind of what I alluded to. I said, we don't know where this is going to end up, what's happening right now, but what I can say is that this is setting the groundwork for the next upward and boom cycle, because this is where the destruction has happened and then needs to be built on and recreated after that.
Oh yeah, for sure. And man, I'm telling you, first thing I'm going to do is I'm going to buy a plane ticket to the sunny coast and come visit you on the farm.
Yeah, well, it's not a bad spot to be locked up, let me tell you. All right, so mate, I very much appreciate you coming on today, and thanks for your knowledge, your openness, and everything. If you want to contact PJ, how do they get in contact with you, mate?
Well, you can find me on my website. It's www.keystonefinancial.com.au. There's some good resources on there. I do specialize in helping self-managed super funds, and obviously one of my specialities is risk management. So if you are concerned about how your investments are being risk managed, then certainly you can find my contact details on my website.
Excellent. If you missed that, you can contact us and we'll put you in touch with PJ if you're chasing him down. All right, don't forget to look, we're not back on air till maybe late next week because of Easter. But if you want to be updated on everything that we're doing, including these type of chats and a whole bunch of other information, you need to join our Zenium program. You need to go to www.zenium.property/join. And if you missed that, replay the video because it's gone down the bottom of the screen about 1,000 times. All right, I'm Scotty from Zenium Live. Today I've been talking to PJ Patterson from Sydney and Keystone Financial Services. Mate, thank you for your time.
Thank you, and happy Easter.
Yep, same to you.